All right, everyone. Markel Corporation kicked off its 2012 shareholder letter with a real bang. This has been one heck of a year. 2012 was busy, and after diving deep into it, we absolutely see why.
Yeah, definitely.
Welcome to the Deep Dive, where we take compelling sources and, really try to pull out the most important nuggets of knowledge and insight for you.
And today, that's exactly what we're doing with Markel's 2012 letter. Markel, it's a fascinating company. They're quite famous for, well, expertly balancing their insurance operations with a very disciplined, long-term investment philosophy.
Right.
This letter, it's not just some dry corporate report. It's more like a masterclass in resilient business growth and creating value.
So our mission for you today is basically to unpack the key financial highlights, those strategic moves they made, and the enduring principles that really guided Markel back in 2012. We'll explore how they hit record revenues, how they managed to return to underwriting profitability, which is pretty impressive in a tough year, and how they laid, critical groundwork for future expansion.
And all while navigating big challenges like Hurricane Sandy.
Exactly. This deep dive, it isn't just about Markel. It's packed with practical lessons, we think, for understanding how to build a business and invest for the long haul.
And you mentioned a tough year, but honestly, the 2012 headlines from the letter itself are really striking. Just to give you a taste, they actually achieved an underwriting profit despite Hurricane Sandy.
Wow.
They delivered excellent investment returns and made some pretty significant acquisitions like Thompson Insurance, and also formed that big partnership with Haggerty. It really was, as they said, one heck of a year.
That's quite the intro. Okay, with those headlines in mind, let's dive into the sheer scale of what they accomplish, starting with the financials that made 2012, well, such a landmark year.
Right.
Markel's financial snapshot is genuinely impressive. They hit record revenues, $3.0 billion. That was a significant 14% jump from $2.6 billion in 2011.
Yeah, that's a big jump.
But maybe even more telling for long-term investors, their book value per share increased by a full 15% to $403.85.
Indeed. And for a company like Markel, book value per share is often seen as a kind of proxy for its intrinsic value. It's a key measure of how much wealth they're building for shareholders year after year. So that 15% jump, that's a really powerful signal.
Okay.
Beyond that, comprehensive income totaled a hefty $509 million. That's way up from $258 million the previous year.
Huge increase.
But what's really crucial for an insurance company, and where a lot of the discipline comes in, is their return to underwriting profitability. They hit a combined ratio of 97%.
Okay, you mentioned a 97% combined ratio. For those of us who aren't insurance actuaries, can you quickly break down why that number is so important?
Absolutely. Think of the combined ratio as like the ultimate report card for an insurer's core business. It basically measures the money going out for claims and expenses against the premiums coming in.
Got it.
Anything below 100% means they're making a profit from their actual insurance policies, even before you factor in any investment income. So hitting 97% is a very strong improvement from 102% in 2011.
Especially with Sandy in the mix.
Exactly, especially considering the year's challenges. And these numbers, they aren't just impressive for Markel, they offer a powerful lesson, I think, for any business or even individual investors. Consistent, disciplined capital allocation and operational excellence, they can lead to compounding wealth far beyond, just market averages.
It really does sound like a heck of a year for accomplishments. The sheer volume of activity in the letter, from acquisitions to operational improvements, it's kind of staggering. It really underscores their core business model. They're not just an insurance company, and they're just an investment firm. They very effectively balance those insurance operations with disciplined investment activities.
Right. This dual engine strategy, it reveals a pretty powerful lesson. Don't let capital just sit idle. They're using the float, that's essentially the pool of premium money they hold between collecting premiums and paying out claims to drive overall long-term value through smart investments. This creates a powerful compounding effect, which is really fundamental to their sustained success over time.
That dual engine concept sounds incredibly powerful. But like you said, these impressive numbers weren't just luck. They were built on this bedrock of, unwavering underwriting discipline. A foundation strong enough to handle even major storms.
Definitely.
This idea of achieving an underwriting profit, despite Hurricane Sandy, hitting that 97% combined ratio, even while absorbing, 5 points of loss from Sandy, that's incredible.
It absolutely is. And that's kind of the brilliance of it. It's a genuine win-win. They served their policyholders when they were needed most, and they still managed to earn a profit.
Yeah.
This achievement really highlights their whole philosophy on mistakes and learning. The letter actually mentions this fascinating, almost counterintuitive insight from a coach who said, "I think that the team that makes the most mistakes will win."
Huh. How does that work?
Well, the point isn't to aim for errors, obviously. It's more about cultivating a culture where you're aggressive, you try things, and when mistakes inevitably happen, you extract every single possible lesson. You don't get paralyzed by the fear of messing up.
So Markel actually applies that philosophy directly to their business operations.
Precisely. They talk about how past major catastrophes, things like the World Trade Center attack or Hurricane Katrina, they led to painful, yes, but absolutely crucial learnings and ultimately improved their risk management.
Right. Learning the hard way sometimes.
Exactly. And this mindset has given them this long-term record of consistent profitability. They've achieved underwriting profits in 8 out of the last 10 years leading up to 2012 and 14 of the last 20. That's not just discipline, it's really a culture of continuous improvement.
So what's the secret sauce then? How do they actually embed that kind of consistent discipline deep in the company culture?
Well, a key factor is their conservative loss reserve philosophy. They explicitly aim to be more likely to be redundant than deficient.
Redundant meaning they set aside more than they might strictly need.
Correct. And this creates a kind of virtuous cycle. First, it fosters a culture of conservatism, dealing with facts rather than just wishful thinking. Second, it helps the underwriters make good pricing decisions for new business. It stops them from underpricing policies just to get business in the door.
Okay.
And third, it empowers the claims professionals. They can settle losses fairly and quickly because they know the reserves are robust enough. There's no internal pressure to, skimp on payouts.
That makes sense. And that discipline connects directly to the long-term value.
Absolutely. It translates directly. Their book value per share increased at a rate of 13% over the 10 years prior to 2012 and 16% over the 20 years. Now, compare that to the S&P 500's 7% and 8% respectively over those same periods.
Wow, big difference.
It's a powerful testament to their disciplined approach. It really compounds over time.
Okay, so with a rock-solid core insurance business, impressive investment returns, how did Markel then actively, accelerate its growth trajectory in 2012? Which brings us to their strategic playbook, the targeted acquisitions and ventures.
Exactly. Acquisitions are definitely a key part of Markel's strategy to expand and enhance their business, and the 2012 letter details several really important moves. The first big one was acquiring Thomson Insurance Enterprises, or TOMCO. That closed in January 2012.
TOMCO. And what did they bring to the Markel table?
TOMCO brought about 20 specialty insurance programs, really niche fields like medical transportation, senior living facilities, pest control, things like that.
Interesting niches.
Yeah. So Indeed, big name, they announced forming a partnership with Hagerty, the premier classic collector car and boat insurance agency. And alongside that, they acquired Essentia Insurance Company.
Okay.
What's fascinating here is why Hagerty chose Markel. Apparently, McKeel Hagerty and his family specifically selected Markel because of its long-term nature and its commitment to preserving their heritage. It wasn't just a quick financial deal.
That says a lot about Markel's reputation.
It really does. It shows how they build relationships based on shared values, not just dollars and cents.
So it's more than just buying a business. It's like building a true partnership. And they didn't stop there, did they? They also kept integrating First Comp, which they'd bought back in 2010.
That's right. First Comp focuses on workers' compensation, mainly for smaller businesses. It became a really key contributor to their gross written premiums in 2012.
So the earlier acquisition was paying off.
Definitely. Markel effectively leveraged First Comp's marketing and technology expertise across the whole organization. It increased their cross-selling potential among, I think it was over 14,000 retail producers. It's just a great example of maximizing the value from past acquisitions, not just making the deal and forgetting about it.
And beyond insurance, Markel Ventures also saw some significant expansion. Now, these are the companies outside their core insurance business, right?
Precisely. Markel Ventures sort of diversified its portfolio. They acquired companies like Havco, a leading supplier of wood flooring for truck trailers, interestingly enough. Also, Idraco, which is a Dutch dredge manufacturer. And they further strengthened their AMF bakery systems group with additions like Redding and Trump.
So quite diverse.
Very diverse. But these aren't just random purchases. Markel Ventures has a specific approach. They empower the existing management, they take a very long-term view, they help reduce debt, and they focus intensely on customer satisfaction.
And the results seem pretty compelling. The letter highlights AMF Bakery Systems. Since Markel acquired it in 2005, its revenues and earnings were up more than fourfold by 2012.
Yeah, fourfold. That kind of growth, even in an industry like baking, which isn't exactly, rapidly expanding tech, it really demonstrates the power of their hands-off yet supportive approach.
And here's a telling sign of success. The letter mentions zero turnover among senior leaders in Markel Ventures since it started back in 2005.
That's amazing. It truly signifies a successful cultural fit. People want to stay and build there.
Absolutely. Which brings us nicely to the other side of their engine, the prudent investor, Markel's investment philosophy.
Mm-hmm.
In 2012, they achieved excellent investment returns overall, a 9% total return, which broke down to 20% on their equities and 5% on fixed income.
Pretty strong, especially the equity side. And this just adds to their long string of outperformance. They've consistently beaten the S&P 500 over the previous 10 and 20-year periods.
Now, one aspect of their strategy that really caught my eye was their investment philosophy, particularly how they explicitly avoid macroeconomic forecasting. That seems quite countercurrent, doesn't it?
It absolutely is. So many investors spend so much time trying to predict, where the economy's heading.
Right, interest rates, government policy.
Exactly. Markel doesn't try to predict governmental policies, tax rates, or interest rates. Instead, they just cut through all that noise and focus on 4 key questions for individual companies, just one company at a time.
All right.
This very grounded approach avoids speculation and keeps the focus squarely on fundamental value.
So what are these 4 questions that guide their investment decisions? Walk us through them.
Okay, the first question is this a profitable business with good returns on capital and, importantly, without too much debt? This tells them if the company is actually serving its customers well and generating real, sustainable value.
Makes sense.
Right.
Profitability and sensible debt. What's number 2?
Second, is the management team equally and sufficiently talented and honest? Integrity and capability, they're just non-negotiable for Markel.
Talent and honesty. Got it. Third,
what are the reinvestment dynamics and how do they manage capital? So they look for businesses that can consistently reinvest their earnings at high rates of return, compounding value internally. Or if those internal opportunities aren't there, does management allocate capital smartly elsewhere?
Okay, so how they use their cash, basically.
Exactly. And this includes an interesting point they make about tax efficiency for controlled businesses versus just passive stock interests owning the whole company. Avoids that tax drag passive dividends often incur.
Ah, interesting nuance. And finally, the 4th question, the one about valuation.
Right. The 4th question is simply, what is the valuation and what do we actually have to pay to acquire ownership? They echo Charlie Munger here, explicitly stating they prefer to pay a fair price for a great business than a great price for a fair business.
The classic Mungerism.
Exactly. And when those great businesses get irrationally expensive, they demonstrate incredible patience. They just wait.
And that patience is perfectly illustrated by what the letter calls their coiled spring strategy in 2012. Can you explain that?
Yeah, it's a fantastic example of disciplined capital allocation in action. Because interest rates back then were fundamentally historically low, they were actually letting their fixed income holdings mature and just sit in cash, even though the yield on cash was almost nothing.
So they were actively choosing not to reinvest in bonds.
Correct. Because the long-term return prospects just weren't attractive enough for them. This demonstrates incredible patience, just waiting for better, long-term, higher-yielding opportunities to deploy that capital. This coiled spring of cash, combined with the growing investment portfolio they anticipated from the upcoming Altera acquisition, represented a huge potential capital allocation opportunity for them down the road.
Wow, it takes real conviction, real patience to sit on cash like that when everyone else is chasing yield. How does that Markel approach contrast with what we often see today, and what can we, the listener, learn from that patience?
That's a great point. In a market that's often totally driven by quarterly results and chasing immediate returns, Markel's patience really stands out. The lesson here, I think, is that sometimes the most profitable move is actually no move.
Or at least waiting for the right move.
Exactly. Waiting for the optimal one. It teaches us the power of maybe delayed gratification and the importance of having a clear framework that stops you from making rash decisions just because you feel pressure to do something.
Okay, let's shift gears slightly to operational excellence and future-proofing. One major development highlighted in 2012 was the successful implementation of their data warehouse. Now, this was apparently a multi-year effort, pretty challenging because of their history of acquisitions and having all these multiple legacy systems. Sounds like a massive headache.
Oh, I'm sure it was. Integrating disparate systems is always tough. But the impact was profound. The letter states it significantly improved their reserving and pricing analyses, dramatically enhanced their reporting capabilities, and provided a really powerful platform for deeper analytics going forward.
So more than just new tech.
Much more. It's a fundamental shift in how they understand their business, and it was a critical foundation for future expansion and efficiency. And the lesson there applies to any organization, really. Investing in robust data infrastructure is absolutely key to future agility and insight.
They also enjoyed some pretty impressive organic growth too, right? Separate from the acquisitions, their insurance premiums increased, what, 6% in 2012? Where did that internal growth come from?
Yeah, 6% organic growth.
Yeah.
That stemmed from a combination of things. Improved internal operations, enhanced products they were offering, increased marketing efforts, and also disciplined price increases where appropriate.
So the core was healthy.
Exactly. It shows their internal engine was really firing on all cylinders. It proves that even when you're making strategic acquisitions, maintaining a strong focus on internal improvement is absolutely vital.
And then the really big play. Just before the year ended, they announced the acquisition of Altera. The letter described it as a major transaction for 2013 and beyond. Why Altera, and why was this such a significant move for Markel?
Altera was seen as a high-quality insurance operation. It had a proven track record of excellent underwriting performance and, crucially, reserve integrity, that conservative approach we talked about earlier.
So not a fixer-upper.
Definitely not. This wasn't a troubled company Markel needed to fix. It was a strong company to join forces with. The potential synergies and scale from this acquisition were just huge. It created a much larger, more important firm in the global insurance and reinsurance world. Which leads to more business opportunities, a larger balance sheet to support bigger deals, and the potential for optimized returns through efficiencies. And for you, the listener, the key insight might be that sometimes the best growth comes from combining forces with an already strong, like-minded partner, rather than always trying to find and fix a struggling one.
And given everything we've discussed about Markel's culture and values, that cultural fit must have been absolutely paramount.
Crucially important, yes. Altera's focus on underwriting profitability and reserve integrity aligned perfectly with Markel's own core values. This allowed the combined entity, as they put it, to continue to walk away from business when the rewards don't justify taking the risks.
Yet shared discipline.
It's a force multiplier. The acquisition was expected to improve operating efficiency pretty quickly, be immediately accretive, meaning it would add to and enhance key metrics like premiums, investments, and book value per share right away, and also foster talent development by creating new challenges and expanded roles for people in both organizations.
Ultimately, then, this all seems to circle back to what the letter calls the Markel style and its emphasis on adaptability.
It really does. Their enduring values come through so clearly. A deep, long-term orientation, a commitment to continuous learning, a fundamental willingness to adapt and change, and building a dynamic culture that attracts leaders who genuinely want to build great companies, not just, manage some stable bureaucracy.
That adaptability, coupled with their intense discipline, seems like a really powerful combination for navigating what's always a constantly changing world.
Absolutely. It's that blend that makes them so resilient.
So as we wrap up this deep dive into Markel's 2012 letter, let's just quickly recap the most important insights for you, our listener.
Okay.
We saw the undeniable power of strict underwriting discipline, the strategic importance of well-chosen, well-executed mergers and acquisitions, the clarity that comes from a really focused, question-based investment philosophy.
Skipping the macro noise.
Right, skipping the noise. And the immense value of fostering a learning-oriented, adaptable company culture.
Yeah, this has really been a masterclass in long-term thinking and disciplined execution, hasn't it? The ability to learn from mistakes, not fear them, that strategic patience and capital allocation. The coiled spring idea and the just unwavering commitment to a core philosophy. It truly stands out.
And this really raises an important question, I think, for you listening. In your own field, maybe your career or even personal endeavors, where might an unhealthy fear of mistakes be holding you back from being maybe a bit more aggressive, trying new things, and ultimately learning faster?
That's a great question, and maybe think about this too. What coiled spring of potential are you perhaps unknowingly building right now by exercising patience and discipline? Maybe you're waiting for the right opportunities to deploy your own resources or talents rather than jumping at the first thing that comes along.
Good point. Consider how these long-term principles from Markel's journey back in 2012 might apply to your own decision-making, whether that's in personal finance, your career strategy, or maybe just how you approach new challenges day to day.
The core lessons, I think, are just as relevant today as they were over a decade ago. Discipline, learning, patience. They don't really go out of style.
Well said. Thanks for joining us on this deep dive. We hope it's giving you some powerful new lenses through which to view business and investment, and maybe even your own journey.